Ladies and gentlemen, what if one move from the U.S. Treasury could change the outlook for gold almost overnight? Investors are asking whether this is just another policy adjustment or a signal that could reshape markets. If you own gold, or you're thinking about buying it, don't react to headlines alone. The real story isn't what the Treasury did, it's why it did it, and what it could mean for inflation, the dollar, and precious metals. Let's break down the facts before making any conclusions. For years, investors have learned that the biggest market moves don't always begin with dramatic announcements. More often, they start with subtle policy decisions that most people overlook. That's why every serious precious metals investor pays close attention to signals coming from the U.S. Treasury. Not because every announcement changes the game, but because Treasury actions can reveal how policymakers are thinking about the economy, government financing, inflation, and the direction of financial markets. When a Treasury decision attracts widespread attention, the first question shouldn't be, should I buy or sell gold? The better question is, what is this decision telling us about the broader economic picture? That's where experienced investors separate themselves from emotional traders. Markets have a habit of overreacting. A headline appears, financial television starts debating it, social media fills with bold predictions, and within hours people are convinced they know exactly what will happen next. History tells a different story. Initial reactions are often driven by emotion rather than careful analysis. The Treasury plays a unique role because it sits at the center of government financing. Every decision related to borrowing, debt management, or funding operations influences expectations about liquidity, interest rates, and the availability of capital throughout the financial system. Those expectations matter because markets don't simply respond to today's conditions. They constantly try to anticipate tomorrow's. One important point many investors miss is that Treasury actions are rarely isolated events. They usually fit into a much larger economic puzzle. Inflation trends, government spending, tax revenue, debt levels, economic growth, and central bank policy are all interconnected. Looking at one announcement without considering the broader context is like trying to understand an entire movie by watching only a single scene. That's why it's important to avoid jumping to conclusions. A Treasury move may appear positive on the surface while reflecting deeper concerns underneath. Likewise, something that initially seems negative could simply represent routine financial management with little long-term impact. Experienced investors understand that governments often make adjustments based on changing economic conditions rather than trying to send explicit messages to financial markets. Yet, markets naturally interpret those adjustments as signals because they provide clues about future policy direction. Another factor worth remembering is that financial markets constantly search for certainty, but certainty rarely exists. Investors want clear answers. They want to know whether this is bullish, bearish, inflationary, or deflationary. Unfortunately, economics doesn't work that way. Most policy decisions create multiple possible outcomes depending on how businesses, consumers, lenders, and global investors respond over time. That's exactly why patience becomes such an important investing skill. Instead of reacting immediately, disciplined investors ask several questions. Does this action suggest confidence in economic growth? Does it indicate concern about government financing? Could it affect liquidity in financial markets? Will it influence borrowing costs? Is it likely to change inflation expectations over the coming months rather than the coming days? Those are the questions that matter because they focus on fundamentals instead of headlines. It's also helpful to remember that markets frequently price in expectations before official announcements are made. By the time news reaches the average investor, institutional participants have often spent weeks analyzing potential outcomes. That's one reason why markets sometimes move in the opposite direction of what casual observers expect. It's not because the news doesn't matter, it's because expectations had already been reflected in prices. This creates an important lesson for anyone following precious metals. Chasing headlines usually produces emotional decisions, while studying long-term trends builds confidence and consistency. The Treasury's actions should therefore be viewed as one piece of evidence rather than the final answer. Investors should compare them with inflation data, employment numbers, manufacturing activity, consumer spending, credit conditions, and global demand for U.S. government debt. Only then does a clearer picture begin to emerge. Another mistake investors often make is assuming every policy decision has immediate consequences. Financial systems are incredibly complex. Sometimes the effects appear quickly. Other times they unfold gradually over months or even years as borrowing patterns, investment decisions, and consumer behavior slowly adjust. This delayed impact is one reason why successful long-term investors spend less time predicting tomorrow's price movement and more time understanding broader economic direction. It's also worth recognizing that government officials face difficult trade-offs. Every financing decision involves balancing competing priorities, maintaining market stability, controlling borrowing costs, supporting economic activity, and managing an enormous national debt. No single decision solves every challenge. Instead, policymakers continuously adapt as conditions evolve. For investors, that means avoiding simplistic conclusions. A Treasury action isn't automatically good or bad for any particular asset. Its importance depends on how it interacts with other economic forces already at work. This broader perspective becomes especially valuable during periods of uncertainty. When volatility increases, emotions tend to dominate decision-making. Fear encourages investors to sell too quickly, while excitement encourages them to chase rallies they don't fully understand. Neither approach builds lasting wealth. The more productive strategy is remaining informed without becoming emotionally attached to every daily headline. Study the data. Watch how markets respond over time rather than during the first few hours after an announcement. Notice whether broader economic trends begin confirming or contradicting the initial narrative. In many cases, the most meaningful signal isn't the announcement itself. It's how investors, businesses, lenders, and global markets respond afterward. Those reactions often reveal far more than the original policy decision. That's why experienced market participants stay focused on the bigger picture. They understand that Treasury actions matter, but they also recognize that no single announcement determines the future of financial markets. Real trends develop through the interaction of policy, economic fundamentals, investor psychology, and time. So rather than viewing this Treasury signal as a reason for immediate concern or celebration, it makes far more sense to treat it as another valuable clue in an ongoing economic story, one that requires careful observation, disciplined thinking, and a willingness to look beyond the headlines before drawing any lasting conclusions. When investors try to understand where gold might be headed next, it's tempting to focus on one event and assume it will determine the price. Markets simply don't work that way. Gold responds to a combination of forces, and those forces often pull in different directions at the same time. That's why one Treasury-related development can influence expectations without guaranteeing a particular outcome. The first thing to understand is gold doesn't generate income like a bond or pay dividends like a stock. Because of that, its appeal often changes as the broader financial environment changes. Investors constantly compare the potential return from holding cash, bonds, equities, and precious metals. When those comparisons shift, money tends to move from one asset class to another. If Treasury actions contribute to higher borrowing costs or reinforce expectations that interest rates could remain elevated, some investors may initially favor interest-bearing assets over gold. That can create short-term pressure on the metal. Higher yields often make fixed income investments appear more attractive because they offer a measurable return, while gold's value comes primarily from preserving purchasing power over long periods rather than producing regular income. But that's only part of the story. Higher borrowing costs don't exist in isolation. They affect consumers, businesses, housing markets, corporate investment, and government finances. Over time, if borrowing becomes more expensive throughout the economy, economic growth may begin to slow. When growth weakens, investors often start looking for assets that have historically provided stability during uncertain periods. That's one reason gold has repeatedly attracted attention during times of financial stress. This is where many people make the mistake of assuming every increase in interest rates is automatically negative for gold. History tells a much more complicated story. There have been periods when both interest rates and gold moved higher together because inflation remained stronger than expected. In those situations, what mattered wasn't the level of rates alone, but whether inflation was eroding the purchasing power of money faster than interest income could compensate for it. That's why experienced investors spend as much time watching real interest rates as they do nominal ones. The relationship between inflation and yields often matters more than either number individually. Another important factor is confidence. Gold has always served as more than a commodity. For many investors, it represents financial insurance. People don't typically buy insurance because they expect disaster tomorrow. They buy it because uncertainty always exists. When confidence in economic stability begins to weaken, demand for financial insurance often increases. Treasury decisions can influence that confidence. If markets interpret policy changes as evidence that economic conditions are becoming more challenging, investors may gradually increase allocations to defensive assets. On the other hand, If confidence strengthens and economic risks appear to decline, some money may temporarily flow away from precious metals toward assets offering greater growth potential. Neither reaction is permanent. Markets constantly adjust as new information becomes available. Today's expectations can change quickly if tomorrow's economic data tells a different story. The value of the US dollar also deserves careful attention because gold and the dollar often influence one another. A stronger dollar can create headwinds for gold by making it more expensive for international buyers. A weaker dollar can have the opposite effect by increasing gold's appeal globally. However, even this relationship isn't perfect. There have been periods when both gold and the dollar strengthened simultaneously because investors around the world were seeking safety during periods of elevated uncertainty. Financial markets rarely follow simple textbook rules for long. Human behavior, global capital flows, and geopolitical developments frequently reshape those relationships. Liquidity is another piece of the puzzle that often receives less attention than it deserves. Treasury financing decisions can affect how much liquidity moves through financial markets. When liquidity expands, investors generally become more willing to purchase a wide range of assets, including commodities and precious metals. When liquidity tightens, investors sometimes sell even high-quality assets simply to raise cash or reduce overall risk. That doesn't necessarily mean confidence in gold has disappeared. Sometimes it's simply a reflection of broader market conditions forcing investors to rebalance portfolios. This distinction becomes especially important during periods of market volatility. Short-term price declines don't always indicate weakening long-term fundamentals. In fact, some of the strongest advances in gold have occurred after periods when investors initially sold nearly everything during financial stress before returning to precious metals as conditions evolved. Another consideration involves government debt. As borrowing requirements continue growing over time, investors naturally begin asking how governments will finance increasing obligations. Those discussions often lead to broader debates about inflation, currency purchasing power, fiscal discipline, and long-term monetary stability. Gold tends to receive increased attention whenever those conversations become more prominent because it has maintained purchasing power across centuries despite countless changes in monetary systems. That doesn't mean gold rises every time debt increases. Markets remain influenced by numerous variables operating simultaneously. Yet the long-term relationship between expanding debt burdens and investor interest in hard assets remains an important part of the broader investment landscape. Psychology also plays an enormous role. Gold markets are driven not only by economic data, but by expectations about future conditions. Investors attempt to anticipate changes long before they become obvious in official statistics. Sometimes prices move based on fears that never materialize. Other times they remain surprisingly calm until economic pressures suddenly become impossible to ignore. This forward-looking nature makes short-term forecasting extremely difficult. Rather than trying to predict every daily price movement, disciplined investors focus on understanding the environment in which gold historically performs well. Rising uncertainty, persistent inflation pressures, concerns about currency purchasing power, financial instability, and declining confidence in traditional financial assets have often created supportive conditions over longer periods. None of these factors operate independently. Every Treasury action interacts with central bank policy, consumer behavior, business investment, global trade, geopolitical developments, and market sentiment. That's why no single announcement guarantees a lasting move in gold prices. Successful investors recognize this complexity. They avoid making emotional decisions based solely on headlines. Instead, they monitor trends as they develop, compare new information with existing economic conditions, and adjust their views only when the broader evidence begins pointing in a consistent direction. Ultimately, gold should be viewed through a long-term lens rather than a day-to-day trading perspective. Temporary volatility is normal. Sharp reactions to policy news are normal. What matters most is whether the underlying forces affecting purchasing power, financial confidence, and economic stability continue building over time. That's where the real story usually unfolds, not in the first market reaction after a Treasury signal, but in the months that follow as the economic consequences become clearer. Investors who understand that difference are generally better positioned to separate meaningful trends from short-lived market noise. If you've been holding gold for any length of time, you've probably seen this pattern before. A major government announcement makes headlines, commentators rush to declare that gold is either finished or about to soar, and emotions take over the conversation. Yet when you step back and look at history, The biggest mistakes are usually made during moments like these, not because the news is unimportant, but because investors allow short-term emotion to replace long-term discipline. So the better question isn't whether gold holders should be worried. The better question is whether they're prepared. Preparation has always been the foundation of successful investing. Worry reacts to headlines. Preparation responds to facts. Those are two very different mindsets. Gold has never been an asset that moves in a straight line. It experiences rallies that surprise nearly everyone and corrections that test even the most patient investors. Anyone expecting a smooth upward path is likely to become frustrated because volatility is simply part of the market. Understanding that reality makes temporary price swings far less intimidating. One of the biggest misconceptions about gold is that its purpose is to outperform every other investment all the time. That has never been its role. Gold serves a different purpose. Many investors hold it because they want diversification and a store of value that isn't directly tied to the performance of stocks, corporate earnings, or the financial health of any single institution. When viewed through that lens, short-term fluctuations become easier to understand. Think about insurance. Most people don't complain when they pay premiums during years. They never file a claim. They recognize that the value comes from protection, not constant payouts. Gold often plays a similar role in a diversified portfolio. Its purpose isn't necessarily to be the best performing asset every year. Its purpose is to provide balance when other parts of the financial system come under pressure. That perspective changes how investors respond to news. Instead of asking whether today's announcement means they should immediately buy or sell, disciplined investors ask whether the long-term reasons for owning gold have actually changed. Has the broader outlook for inflation shifted dramatically? Has the global debt picture improved substantially? Has financial uncertainty disappeared? Has currency purchasing power suddenly become a non-issue? In most cases, the answers aren't determined by a single Treasury action. That's why reacting emotionally to every headline often creates more problems than it solves. Another important consideration is time horizon. Short-term traders and long-term investors are playing completely different games. Traders may focus on price movements over hours, days, or weeks. Long-term investors often evaluate trends over years. Confusing those two approaches leads to unnecessary stress, because what appears significant on a daily chart may barely register on a chart covering an entire decade. History reminds us that some of gold's strongest advances have followed periods when sentiment was overwhelmingly negative. Likewise, some corrections have occurred during times when optimism reached unsustainable levels. Markets frequently move contrary to popular opinion because expectations eventually become priced into asset values. This is why patience becomes such a valuable asset. Patience doesn't mean ignoring new information. It means evaluating information carefully before making decisions. It means recognizing that one announcement rarely changes the entire investment landscape overnight. Risk management also deserves attention. No experienced investor should depend entirely on one asset, regardless of how optimistic they may feel about its future. Diversification exists for a reason. Different assets perform well under different economic conditions. Gold can play an important role within that mix, but it doesn't eliminate the need for thoughtful portfolio construction. Prepared investors understand this. Rather than concentrating everything in one position, they build portfolios designed to withstand multiple economic scenarios. Some assets may benefit from stronger growth. Others may perform better